The biggest market event this week wasn't inflation, it wasn't oil, and it wasn't even the US Federal Reserve. It was SpaceX. Now, most commentary around SpaceX has focused on the company itself, but I think that misses the bigger picture. And so if we think about the real significance of SpaceX is, I think, about public markets being asked to essentially fund the largest capital formation event in history. Precisely at the moment, the AI economy is becoming more capital intensive, a lot more concentrated and more dependent on liquidity. So for the last 2 years in the investment community, we've debated whether AI could justify the earnings growth, the valuations that have been embedded into market pricing. But the debate, I think, is evolving, and the more important question today may be whether capital markets can fund the scale of infrastructure required to support the next phase of the AI build-out. If we think about what's required, there's data centres, there's power generation, there's power grids, semiconductors, as we know, networking infrastructure, the fundings through private credit, private equity issuance, and space-based communications are a thing as well. So the AI story is no longer just an old software story. It's increasingly an infrastructure story. And so SpaceX, I think, sits right in the middle of that transition. And that's why I think SpaceX is less an IPO story and more a market structure event. And one of the most important signals this week was the continued concentration of capital in a very small number of perceived winners. We've seen it with AI, we've seen it before with semiconductors, and now we're seeing it with space infrastructure. So investors appear increasingly willing to allocate really extraordinary amounts of capital to dominant platforms while pulling capital away from secondary competitors. And so the signal that AI is increasingly becoming a funding story. So, every dollar of AI capital expenditure becomes revenue somewhere else in the system. And for semiconductor companies, for networking companies, for industrial companies, it's all part of the ecosystem. So, infrastructure providers. But that also means the entire ecosystem becomes increasingly dependent on continued access to capital. So the third signal is that markets are becoming more selective. That distinction emerging is between AI infrastructure and AI applications. The infrastructure providers continue to attract capital because they own scarce assets. Meanwhile, software companies are facing a much more complicated environment as AI compresses barriers to entry and really challenges traditional business models in many ways. Oil continues to remain a really important transmission mechanism between geopolitics and markets. Investors continue to look through geopolitical events until they affect energy prices, inflation expectations, and interest rate pricing. And so that leads to the final signal this week, which is, bond markets remain the ultimate constraint. So the AI build-out requires capital. Capital has a cost. If inflation remains sticky and yields move higher, obviously the hurdle rate rises. That doesn't end the AI story, but it changes the valuation framework around it. So while SpaceX was the headline this week, the biggest story is that markets are entering, I'd say, a new phase of the AI cycle. A phase defined not by technological possibility alone, but by capital formation, infrastructure ownership, and competition for scarce resources. And that may prove to be one of the most important investment themes of the next decade. These views are mine and do not necessarily represent the forum or any of its affiliates.